Hi, in algo trading, everybody talks about entries. Entries. But what about exits? I'm going to talk about them in this video. I'm champion trader Kevin Davey, and let's get started. Hey there, and thanks for joining me. Today I'm going to talk about over 500,000 backtests and what it taught me about algo trading exits. Now, for most people, they consider exits the ugly stepchild. You know, they spend a lot of time on entries or position sizing and all these other things, and very little time on exits. Yet exits are really, really important. They can make or break a strategy. They honestly can, and we're going to show that today. And I'm here to kind of blow the roof off of the whole idea of exits don't matter, because they absolutely do. So like I said, I tested over 500,000 tests, different strategy combinations, different exits, entries, and I'm going to show you what I've done, and we're going to learn about what's important with algo trading exits. So here's the first group of exits that I wanted to test. I wanted to test some simple exits. These are things people normally do. A stop and reverse, a time-based exit, dollar stops, ATR stops, and profit targets, and combinations of the two. So altogether, there's 8 different exits here I'm going to test. I'm going to show you in this video. And none of them are terribly complicated. A lot of people use these types of exits. Well, how do they compare? How do they work? Let's find out. So to do all my testing, I'm going to be using TradeStation. I've been using TradeStation for about 15 years now. It's one of the best, if not the best, platform for backtesting. But you can use a lot of different tools to backtest. You can even create your own backtesting tool. So I don't want to say, hey, this is the only way to do it, but this is the way I do it. And the code I'm going to show you in this video will actually be TradeStation code. So if you're interested, go to tradestation.com and find out about them. It's a really good platform. All right, so I'm going to test some exits, but I want to test them with a bunch of entries, because maybe it's the entry that really matters, and then I'll test a bunch of exits and I really won't find anything. So I'm just going to use 5 more or less standard, quote unquote, standard entries. I'm going to use a simple momentum entry, a breakout that just enters the next bar. A lot of people use things like that. Simple moving average crossover. I mean, I think everybody's used that before. A Bollinger Band entry, and then a volatility-based entry. So these aren't exotic entries. They're pretty standard, but I think a lot of trend followers will use one of these or something similar. So it's a good test of all the different exits. See how the exits perform with different entries. And then I don't want to limit myself to one market or a group of markets, maybe like the stock indices, because you'll find a lot of differences in the way strategies perform, from energies to metals to currencies. Things could be a lot different. So I'm going to test 40 different futures markets. And you can kind of see the list here. I've broken it up into 6 different market sectors, and there's a few in each one. There's a lot more in the ags and softs. I probably could have broken up the ags into just the agricultural type ones and softs, which would be like cotton, cocoa. But I just lumped them all together. And a lot of times they'll all perform differently. So they're a good group to have. So you can see I have 40 different markets that I'm testing. So it's going to be a wide range of markets. And hopefully we'll be able to draw some conclusions about exits. And then bar sizes. People don't think enough about bar sizes, but you could have daily bars. You could also have 1 minute bars. Now for this test, I'm going to go from 60-minute bars up to 1440 minute bars, which in effect would be daily bars. And I'm going to take 5 different bar sizes. So I'm trying to get a range of short-term bars, long-term bars. I'm not going to put any requirements about strategies exiting at the end of the day. They're all going to be swing type strategies that could go for a couple days, or they could exit the same day. It all depends on the signals. I'm going to run it for 10 years. So it's going to be a pretty substantial back test. It's going to be from January 1st, 2010 to basically January 1st, 2020. So it's going to be 10 years worth of data there. And of course, I'm always going to include slippage and commission. Watch out for that. I talk about that in my other videos where people like to show results without slippage and commission, which just drives me nuts. You have to include slippage and commission. So I'm going to include it here. And, you know, the next big thing is, how do you determine what the best result is? Because there's a lot of different criteria. You could say, oh, hey, I want the best net profit, or I want the lowest drawdown, or I want the number winning percentage to be the highest, or the number of consecutive wins. So a lot of different numbers you could use. And frankly, we could talk all day and argue about which criteria is the best. Oh, it's Sharpe ratio, it's Sortino ratio, it's the Arena and index. There's a whole bunch of different things. So I'm just going to take a couple. I'm going to take return on account, which incorporates profit and the max drawdown. So it gives you an idea of both the upside in the profit and the downside in the risk with the drawdown. And I'm also going to put another metric, which is the number of cases that have a high net profit. And I'm going to use $25,000. So basically, if I made $25,000 over that 10-year test, that counts as a win or a good test. So I'm going to count the numbers of those, because one of the things you want to see in whatever you're testing is you want to see a lot of profitable, highly profitable cases. So that might be a good metric. We'll see. Of course, your results may vary from what I'm testing. Maybe you're using different markets or different entries or different exits. You could be using different amounts for slippage and commission. You could be using a different platform, and maybe it tests a little differently. Not every platform tests the same. There could be issues with futures data, with rollover dates. So I want to caution you that what I'm showing here is what I got, but what you may get might be something different. So your results may vary. So keep that in mind. If you watch enough of my videos, you'll know I always, always, always try to tell people, verify it for yourself. You know, just don't take what's in this study and go run off and start trading it. Verify it in your platform. Verify it. Make sure you feel comfortable with it. That's important. Okay, so before I start revealing the results, if you've liked what you've heard so far and you think you're going to like what you're going to hear, which I know you will, please just do me a small favor. Just give this video a thumbs up. I'll wait. 1, 2, 3, 4. Okay, that should be enough for you to give it a quick click of the thumbs up. And, I mean, subscribing to my channel is one way to always find out about my latest videos. And if you go to my website, kjtradingsystems.com, if you're not already on my email list, sign up. You can always unsubscribe, but in the meantime, I'll send you a free algo that you can start algo trading on your own, and you can look at and start to tear apart and test and do all sorts of crazy things with it. So subscribe to my channel, subscribe to my email list. All right, let's go on with the results. So test number 1, I'm going to test only 2 of the exits, a stop and reverse exit and a time-based exit. I happen to like both of these, and so I just wanted to see which one's better. Now, here's the code for the stop and reverse. And you might say, well, wait, that's just an entry code, right? If the momentum's up, you buy, and if the momentum's down, you sell short. So where's the exit? Well, the way TradeStation's set up is when you go to buy, you're also exiting any short position. So that makes this code a stop and reverse code. So if you're short and you want to go long, you exit the short, go long, and vice versa for short trades. So in these 2 lines of code, it's not only the entries, but it's also the exits. And so I'm going to use that as a baseline because that's pretty much as simple as it gets, you know? And here's a time-based exit. So I'm saying if market position, that's MP, is equal to 1, and I have a certain number of bars since I entered, then I sell. I exit the long trade. So I don't go short, I just exit the long trades and I go flat. And vice versa for the short trades. I'll just exit the short trade and I'll be flat again. So the top code is always in the market, long or short. That makes a stop and reverse. And then if you add in the bottom code, the time-based exit, at any point in time, your strategy could be long, could be short, could be flat. Okay, so that's kind of how it is. So let's take a look at the results. So on the left, I've got average return on account. And on the right, I've got the number of profitable cases, okay? And you can see both times the stop and reverse just blows away the time-based exit. I mean, there's no comparison. One thing to note though, look at the stop and reverse. It's actually negative. So what does that mean? Well, it means over the number of markets I tested and all the time frames and all the entries and everything I did, the stop and reverse loses money. So does the time-based exit, but the stop and reverse, regardless of the entry, when you average them all together, it loses money. So that's something to keep in mind. It's not this, hey, great exit that works in every market all the time, all these bar sizes. You got to remember that. On balance, it loses money. So that just says, hey, that super simple thing is not a universal thing. You'll see in a little bit, there's going to be times where it does work on certain markets, but it doesn't work all the time. And you can see the number of profitable cases, it's the same way. Stop and reverse beats out time-based exit. Well, you could say, okay, well, maybe there's a couple markets that are like this. Maybe it's the metals, or maybe it's stock indices that are kind of destroying the results for everything else. So I decided to break it down a little bit. And let's just see, does this hold up over markets and time frames? Well, here it is versus markets. And you can see, if you compare the first 2 lines, in ags, the stop and reverse is better. In currencies, it's better. In energies, it's better. In metals, rates, and so on. It's better everywhere. And notice where I have it highlighted, it actually makes money. So across all those metals I tested, the stop and reverse on average makes money. And in the stock indices, it does really well compared to, say, the ags. So that's kind of interesting. So there are certain market sectors where this stop and reverse works a lot better than other market sectors. So keep that in mind. And you see the same thing with the number of profitable cases. But again, stop and reverse, pretty much regardless of market sector, beats out those time-based exits. Well, let's look at the bar size. So a lot of people don't even test this. They'll just kind of go in with a certain bar size. But I wanted to test a few different bar sizes. So going from 60-minute up to daily bars. And how does it look? Well, the data in the table is kind of hard to tell, although you can see stop and reverse is better than the time-based exit. But when you put it on a chart, you see on average, the shorter the bar size, the more likely you are to get false signals and to get worse results. So the 720 and the 1440, those half day to full day sessions, those are the best ones overall. So this kind of confirms what I've taught people in my workshop for years, that the lower the bar size, the smaller the bar size you go, usually the worse the results are. And you definitely see that here. Okay, so we looked at the market sector, we looked at the bar size. Maybe it's just certain entries, right? And maybe certain entries work better for certain things. Well, when I broke it down, stop and reverse exits, like breakout entries, then Bollinger Bands, then the volatility entries. And same thing, different order with the time-based exits. They like the Bollinger Bands, the volatility, and the breakout. So regardless of the exits, certain entries tend to do better. And when you look at the entry look back length, each one of those entries has a certain look back length. So for a moving average, if I'm using 15, it takes the average of the last 15 bars, for example. And you can see here that the time-based exit isn't very sensitive to it. And the stop and reverse is a little sensitive, where you actually get better results with the smaller look back periods. So not a dramatic difference, and taking the average of them probably doesn't affect the overall results too much. I was hoping to see something where a look back of 15 was like 10 times as good as a look back of 35, and I didn't see it. Pretty much no matter what you do, look back wise, you get about the same results. So to sum up part one, stop and reverse. It's the winner, and it kills the time-based exit. So what you can do in your own trading is first just try it with stop and reverse, okay? And see how it looks, and then maybe add the time-based and see if that makes things better. This was actually kind of a surprising result to me, because I've been using time-based exits a lot, and I like them a lot. This says, hey, maybe stop and reverse is better. Of course, the drawback with stop and reverse is you're always in the market, long or short. Now, some people would say, hey, that's good because you're probably likely to catch a trend. And I can't disagree, but you're always in the market. So if you get caught on the wrong side of a trend, there's nothing to get you out, where a time-based exit would. So that's the results of part one. Now, part two, I want to test some more exits. So I'm going to do some dollar stops, dollar targets, and dollar stop and targets, okay? So the dollar stop is pretty simple. Hey, if I lose $500, get me out. Dollar target. Hey, if I make $1,000, exit with a profit, okay? And then the third variation is obviously having both together. So I'm going to be in this trade until I either make $500 or lose 1,000, or vice versa. There's different variations, and I tested some variations of that. That's what the dollar target and stop look like. And then I do the same thing with the ATR, because a lot of people don't like using dollar for futures contracts. They'll say, oh, the average true range, that's more important. And if you look on my YouTube channel, I did a whole video on that subject of comparing ATR stops and dollar stops. So this is kind of a continuation, or sort of a different flavor to it, what I'm doing here. But same with the dollar stops and targets, I'm going to do with ATR. So I'm going to have an ATR stop by itself, an ATR target by itself, and then an ATR stop and target together. And you see the TradeStation code here, so you can kind of follow along. So here's the results. I also added in the time-based exits just so, and the stop and reverse, just so you'd be able to see how those compare. And when they're sorted in order, guess what? The stop and reverse still wins. The dollar target comes pretty close. So this is saying, hey, just stay in a trade until you make a certain number of amount of profit, and then get out. That's pretty close, but really the stop and reverse still wins. And again, you might say, well, hey, maybe this is just a certain market, a certain sector, a certain bar size. So I decided to look at different market sectors and, to see, does it hold up across a whole bunch of different things? And here you go. Usually the stop and reverse is the best for market sectors. There's a couple cases where the dollar target kind of sneaks above it, but you kind of see the same thing that we saw earlier where, hey, the stop and reverse just doesn't matter what market sector you're using, the stop and reverse works the best. And when you look at bar sizes, same thing, really. A little bit with the daily bars, the dollar target just beats out the stop and reverse, but it's not that significant. The big thing, again, stop and reverse wins, and daily bars tend to be better than those lower time periods. And then when you look at the entries, regardless of the entry involved, the stop and reverse is almost better. So here's 6 more exits that I've kind of thrown into the mix and said, hey, can these beat out that stop and reverse? And you know what? Some come close. That dollar target comes close. But at the end of the day, it can't beat stop and reverse. And on the downside, look at the worst one, which is the ATR stop and target. For some reason, that came out to be a lot worse than everything else. And again, your results can vary. Maybe it's the levels I was using, because I was using some different values for stops and, for the dollars and for the ATRs. So you should always test this yourself to make sure. But this kind of gives you an idea of maybe where to start your testing. So you don't necessarily have to start from scratch. And that should make this very helpful. So part 2, the quick takeaway is, again, start out with stop and reverse, and then maybe you can start adding some. And the first thing I'd always try are the dollar target exits. And I'll tell you, in my own trading, in my own development, this isn't something I used to try right off the bat. If anything, I would try time-based exits, which we saw earlier. They're not so good. But maybe you put the dollar target in. In the theory, if you're thinking about this from a market perspective, is you get in, you get out with a profit, and then you head to the sidelines. Okay, you don't let the profit retrace and come back until there's a stop and reverse entry. So in that respect, it's good. And actually, I didn't look at it, but if I looked at maybe percent of time in the market, maybe those dollar target exits would make it even better, because the stop and reverse, you're in it 100%. And maybe you really don't want to be in the market 100% of the time, Maybe you want to get in, get your profit, and get out, which, hey, I can't argue that that would be a good thing. So first try stop and reverse, then maybe try the dollar target, and then some of those other ones, they're just lower down the list. I'd still test them if you want, but don't expect too much from them. So that's where we're at with exit testing. Again, If you like this video, please, small favor, just give it a thumbs up right now. Just go over there and click it. I know you can move that mouse. Do it! And subscribe to this channel while you're at it. That button's really close too. And if you want a free algo, just go to my website, sign up for my email list. I don't bombard you with emails. You can unsubscribe anytime you want. Well, hey, thanks for watching. And be sure to watch some of my other videos. I'm going to have more exit tests in some other videos. I'm Kevin Davey. Thanks for watching.